A 71-year-old retired teacher walked into her bank last winter to withdraw $14,000 of her own money she had saved over decades, money sitting in an account under her own name, and the bank told her no. Not because the funds were not there, not because of any fraud alert on her account, because of a rule that 7 federal agencies quietly endorsed, a Supreme Court decision that expanded the legal framework around it, and a banking software upgrade that almost nobody in the mainstream press has explained clearly to the people it affects most. And that woman is not an isolated case. Versions of that story are playing out at bank windows across this country every single week, and the people experiencing it are overwhelmingly over the age of 60. I am going to tell you exactly what is happening, why it is happening, and most importantly, what you can do about it, because there is a specific free 5-minute action you can take at your bank this week that changes your situation entirely. But I need to walk you through the full picture first, because the solution only makes complete sense once you understand the system it is designed to work within. There are 3 things that have changed recently that every senior needs to understand about how banks are handling large transactions in 2026. There are also 3 dangerous myths spreading online right now that could cause you to do exactly the wrong thing. We are going to cover all of it. Let's start with the foundation, because everything else builds on it. The $10,000 rule, formerly the currency transaction reporting requirement, has been federal law since 1970. Any cash transaction over $10,000 in a single day triggers an automatic report called a currency transaction report. The bank files it. It goes to FinCEN, which stands for the Financial Crimes Enforcement Network, a bureau inside the Treasury Department. The report is automatic, and the bank has no discretion about filing it. It goes regardless of who you are, how long you have banked there, or how clean your money is. Here is the context that makes this rule feel completely different in 2026 than it did when it was written. In 1970, $10,000 was more than the average American earned in an entire year of working. It would buy 2 brand new Cadillacs. Gas cost 36 cents a gallon. A house cost $23,000. The rule was designed to catch drug traffickers moving suitcases full of cash, not a retired firefighter withdrawing money to fix his roof. And here is the part that the Government Accountability Office, the federal government's own independent watchdog, reported just last year. If that $10,000 threshold had been adjusted for inflation the same way Social Security payments are adjusted every year, it would sit at approximately $73,000 today. Instead, it has not moved a single dollar since the day it was written, which means a rule designed in 1970 to catch criminals is now routinely catching grandmothers paying contractors. The Supreme Court's recent activity around financial privacy, government access to bank records, and the legal boundaries of federal financial surveillance has brought renewed attention to exactly this framework, validating some aspects of the government's authority while raising important questions about others. What that means in practical terms for seniors is that the legal architecture around your bank transactions is more actively in use, more automated, and more consequential than it has ever been. And 3 specific changes have made 2026 a genuinely different environment than anything that came before it. The first change is the one that explains what happened to the retired teacher I described at the beginning of this video, and it is the change that surprises people most when they encounter it for the first time. In December of 2024, 7 federal agencies, the FDIC, the Federal Reserve, the Consumer Financial Protection Bureau, the Office of the Comptroller of the Currency, the National Credit Union Administration, FinCEN, and state banking regulators issued a joint statement. That statement told banks they are actively encouraged to place temporary holds on transactions when they have reason to suspect that an older adult account holder may be experiencing financial exploitation. Depending on which state you live in, that hold can run anywhere from 15 days to 45 days. Florida law authorizes holds of up to 45 days. Georgia and Kansas go up to 25 business days. Other states have their own specific rules. And the data behind this policy is genuinely sobering. FinCEN's own reporting found that over $27 billion in suspicious activity tied to elder financial exploitation flowed through the banking system in a single year. The holds exist to stop scammers from draining senior accounts before anyone can intervene. That is the good version of this story, and it is a real and important version. But here is the other version, and it is equally real. The retired teacher trying to pay a legitimate contractor for legitimate work on her legitimate home gets her withdrawal frozen for 2 weeks while the bank conducts its review. She has done nothing wrong. Her contractor is licensed and reputable. The job needs to be done. And she is standing at a bank window being told she cannot access her own money for up to 45 days. Both versions of that story are happening simultaneously at banks across the country, and which version you experience depends heavily on one specific thing I am going to explain shortly. Keep that in your mind as we go. The second change, or more accurately, the second area where significant confusion has been created, involves digital payment platforms like Venmo, Zelle, PayPal, and Cash App. After my previous video on banking rules for seniors, the single most common message I received was some version of this. I heard the IRS is watching every payment over $600 on Venmo, so I stopped sending my grandchildren birthday money. And I want to address that directly and clearly because the fear spreading around this topic is causing seniors to pull back from completely normal family financial activity based on something that is not accurate. Here is what actually happened. There was a proposal debated and delayed for several years to lower the reporting threshold on third-party payment processors to $600. That proposal created enormous confusion and significant media coverage every time it was discussed. But in 2025, Congress passed legislation that settled the question. For 2025 and every year going forward, Venmo, PayPal, and Cash App are only required to report to the IRS when a user receives more than $20,000 and more than 200 separate transactions in a single year, and only for payments that are designated as business transactions. Personal payments between family members and friends are not reported as income through those forms. And Zelle operates on a different model entirely. It runs on direct bank-to-bank transfers rather than functioning as a third-party payment processor, which means it does not issue those tax forms at all. If you send your granddaughter $300 for her birthday through any of these platforms, that transaction is not on any IRS income reporting list. If your adult child sends you $5,000 through Venmo marked as a personal payment to help with a medical expense, that is not taxable income being reported to the federal government. The $600 rule that caused so much anxiety never actually took effect, and the law that was passed in 2025 ensures it will not. Keep helping your family. The fear around this was real, but the underlying threat was not. The third change is the one that is costing ordinary people real money right now, not because of any new law passed in Washington, not because of any explicit policy targeting seniors, but because of software upgrades inside bank compliance systems that almost nobody in the financial press is talking about plainly. The pattern detection software that banks use to identify suspicious transaction behavior has become significantly more sophisticated, and that sophistication is creating real consequences for people who have never done anything wrong. Let me give you a concrete example of how this played out before the current software upgrade, because it illustrates the shape of the problem clearly. A grocery store owner in Michigan, a man in his 70s who had run his business for 3 decades, had an insurance policy that capped his cash coverage at $10,000. So he deposited below that threshold regularly, not to avoid reporting requirements, but because his insurance situation made that the practical thing to do. An algorithm flagged his deposit pattern as potential structuring, the federal crime of breaking up transactions specifically to avoid the $10,000 reporting requirement. The government seized approximately $35,000 from his account. It took 2 years of legal work and the involvement of a public interest law firm to get his money back. And a Treasury Inspector General audit found that in more than 9 out of 10 structuring seizure cases reviewed, the money involved had been legally earned. These were not criminals. They were small business owners, farmers, and retirees whose transaction patterns matched a shape on a computer screen. Here is why this matters specifically in 2026. The software running inside bank compliance systems today is more sophisticated than anything that existed when that grocery store owner's account was seized. It catches smaller patterns. It cross-references transactions across multiple branches. It identifies behavioral signatures that go well below the $10,000 statutory threshold. The legal line in the law has not moved. It is still $10,000 unchanged since 1970. But the bank's internal detection radar is paying close attention to amounts well below that number, which means the old informal advice that used to circulate, just keep your transactions under the threshold and you will be fine, is now precisely the behavior pattern that will get your account flagged. The world around the rule has changed, and the advice that used to be harmless is now genuinely dangerous. Before I get to the specific actions you need to take, I want to address 3 pieces of misinformation that are circulating widely right now, because any one of them could cause you to do exactly the wrong thing at exactly the wrong moment. The first myth is that the reporting threshold has dropped to $7,000. It has not. The law still says $10,000. Banks' internal software may flag patterns at lower amounts, but the currency transaction report threshold written into federal statute has not changed by a single dollar since 1970. Anyone telling you the threshold dropped is either mistaken or deliberately misleading you. The second myth, and this is the dangerous one, is that your bank will send you a letter informing you that a suspicious activity report has been filed on your account. This story is circulating in videos and articles, and it is simply not true. Federal law, specifically Title 31 of the United States Code, Section 5318, makes it a crime for any bank employee to tell a customer that a suspicious activity report was filed. A bank employee who disclosed that information would be personally breaking federal law. So when you see content describing a retired couple receiving a letter from their bank about a suspicious activity filing, that story cannot be real as described. What you might actually receive is a source of funds letter, a routine compliance request asking you to document where large deposited funds came from. You respond with your paperwork, the review closes, and the matter is resolved. That is a completely different thing from a suspicious activity notification, and treating them as the same thing leads to unnecessary panic and sometimes exactly the wrong response. The third myth is that being over 65 means the government is watching your accounts more closely than everyone else's as a form of surveillance. The elder protection framework I described earlier is designed to shield seniors from financial predators, not to surveil them. The additional attention that banks are directed to give senior accounts is aimed at keeping scammers out, not at treating older Americans as suspects. And if you take the action I am about to describe, you are the one controlling that protective framework rather than simply being subject to it. Everything I have described today, the transaction holds, the compliance reviews, the pattern detection software, all of it comes to a single practical point, and that point is one specific form available for free at every major bank in the country. It is called the Trusted Contact Designation Form, not the Senior Safe Banking Authorization. That name is floating around online, and it does not correspond to any real product at any major US bank. The correct term is Trusted Contact Designation. Ask for it by that name. Here is what it does and why it matters so much. You fill it out once. You write down the name and phone number of one person you trust, an adult child, a sibling, a longtime friend. That person receives no access to your money. They cannot make withdrawals. They cannot see your balance. They cannot sign anything. What they can do is answer the phone when your bank calls. And that phone call is what transforms a 15-day account hold into a 20-minute conversation. When the bank calls your trusted contact and that person can confirm that yes, the transaction is legitimate, that the contractor is real, that the decision was made freely and with full information, the hold resolves. The money moves. The protection worked exactly as it was designed to work, and your life is not disrupted for 2 weeks. Without that form on file, the bank completes its review on its own timeline with no one to call who knows your situation. With that form on file, you have someone positioned to cut through the process immediately. That is the difference between the two versions of the story I described at the beginning of this video. One form, one name, one phone number, 5 minutes at your bank this week. Let me give you a plain language summary of everything this video covers because the framework is simple even though the system around it is complicated. When you make a large cash transaction at your bank, state your purpose clearly at the window. Do not split deposits to stay below any threshold. That behavior pattern is exactly what the software is designed to detect, and it is the behavior that turns a clean financial history into a compliance problem. Keep your documentation organized so that if you ever receive a source of funds letter, you can respond to it quickly and clearly with paperwork rather than explanations. And get the trusted contact designation form filed at every account you own. There is also a development in Washington worth knowing about. A bill was introduced in late 2025 called the Streamline Act. If it passes, it would raise the $10,000 reporting threshold to $30,000 and require the Treasury to adjust it for inflation every 5 years going forward. I cannot tell you whether it will pass, but the conversation in Washington about modernizing a rule written in 1970 for a world that no longer exists is finally moving in a meaningful direction. If that law changes, you will hear about it here first. You worked your entire life for the money in your bank account. You raised a family on it, saved it through decades when saving was not easy, and you should never have to feel uncertain or afraid when you walk up to your own bank window. The system around your money is more complicated than it used to be, but it is navigable when you know what is actually in it. Now you do. Share this with anyone over 60 who moves real money through a bank account. That trusted contact form might be the most important 5 minutes they spend this year. Drop your state and your question in the comments. I read every single one, and the situations that come up most often become the next video. I will see you there.